Good evening. Welcome to Admiral Markets live webinar. My name is Chris. Thanks for joining our webinar today. We're going to take a look at intraday charts and systems. First of all, though, be aware of these disclaimers. This webinar is shown to a global audience, but may not be suitable for everyone. Please visit admiralmarketsglobal.com, select your country of residence, and contact an appropriate entity for more details. Also, please be aware that trading for exchange and global financial markets is considered high risk. Please seek the advice of an independent financial advisor for more information on that. This webinar is for informational and educational purposes only. By continuing watching this webinar, you agree with this disclaimer and you are aware of the risk involved when trading. All right, today I'm going to take a look at the intraday systems. Nennet will be joining us next week again. Nennet is having a seminar today, a live seminar, so he will not be able to join. But I got some good stuff lined up, so I hope you'll enjoy it despite Nenet's absence. We're going to take a look at a couple of things. On live charts, we're going to take a look at basically candlestick confirmations, candlestick patterns using an indicator for that. So candlestick indicator with Admiral Markets Keltner band. We're going to be taking a look at a new type of moving average that you see right now in combination with oscillators and Fibonacci sequence levels. And we'll be taking a look at fractals, time factor, and Admiral Markets pivot points. So those are the three things that are going to be lined up for us today. Let's get started. I'm excited. I think that everyone is, of course, interested in trading intraday trading. Well, not everyone, but many of you, and trading basically combinations of indicators and candlesticks. So I want to start with the candlestick one. This is an indicator that shows the patterns, shows candlestick patterns, bearish and bullish. It can look a bit kind of messy in a way because there's a lot of text visible on the chart. And from that point of view, it kind of looks maybe busy. Let me take away for a second these oscillators so we just can focus on at least the key points. But then again, you know, if you really only have this indicator and you maybe have an Admiral Keltner indicator, it could be doable as well. If you stretch the charts, I think it should be visible for you as well. Oh, sorry. There we go. That was a mistake. So now you should be able to see the screen. Good. Sorry for that. So looks a bit messy, but then again, you see the candlestick patterns pretty clear. Now, of course, obviously, if you've been trading for years and years and you've been looking at candlestick patterns for a long time, you don't need the indicator. But to start out, or if you've been looking maybe for a few months or you're not sure about the patterns yet, it is a good place to start with, to build the experience, to recognize the patterns quickly without overanalyzing it and do it quickly, right, without spending too much time on it. So it's kind of a shortcut in a way for those that are training wheels maybe, but it's very useful at the beginning of intermediate. If you've been trading for years, you don't need it. You can just look at candlestick patterns. The idea is that the Keltner basically helps with identifying the decision zones. So Keltner, when we talk about the Keltner band, it's part of the MetaTrader 4 Supreme Edition. It's a band, so you have support and resistance in one shot, in one overview. And you can download the MT4 Supreme Edition for free. It's an indicator package developed by Admiral Markets. There are a lot of other things connected to it, money management and order management and testing stuff is included as well, including the indicator package. So what the bands do basically is give you an idea about how far prices has expanded, or if it's basically bouncing or breaking levels that we deem, let's say, reasonable. All right. One of the things I look for with the Admirals is the candlestick patterns at those levels. So here, for instance, when you have a strong candle pushing through the band like this, this is typically an area where we have a breakout. A strong candle would be a candle close near the high or a candle close near the low. A candle like this, for instance, let's zoom into this one, right here. This one right here, the one right of the right level. You see that that's a candle fully going through the Keltner. We want a candle, first of all, that is closing above the Keltner in bullish environment or closing below the Keltner in bearish environment. We want a candle close that is near the high or low, preferably within 20%. So when calculating the candle, the top wick for a bullish break or the bottom wick for a bearish break is only 20% of the candle, max 33%. All right, you can see the candles hopefully at the top part there that I'm drawing. So do you see those candles? So that is a good candle close basically, or breakout candle. If there is a big wick, if there is no candle close near the high or low, that indicates failure, that indicates a bounce. Those are not good breakout candles. Also, the candle should have a decent size. So those are things that basically we need to keep an eye on when looking for breakouts. This is a good breakout candle. It signals that price should continue above the Keltner, and therefore there's a momentum breakout. So when we see these types of candles, we should expect continuation. When we see candlestick patterns at or above the Keltner, we could expect reversals. So that is basically what I want to discuss here is reversals. When you see, for instance, candlestick patterns at the Keltner, we should expect a retracement. I want to explain that the candlestick patterns that we see above the Keltner for a bullish environment or below the Keltner for bearish are ones that should be ignored. We want basically the first candlestick pattern that is within the Keltner after price broke above the Keltner. So step one is breakout above Keltner. Step two is price going back into the Keltner. Step three is a candlestick pattern in the Keltner. All right, because the candlestick patterns above the Keltner or below it are not ready yet. Typically, the momentum is too strong, like here, for instance. These are reversal candlestick patterns, but price still pushed further. Here too, a bunch of reversal patterns, but price still continued further. Typically, the first reversal that succeeds is the candlestick pattern that we see visible in the Keltner. This one you see right here, and we see a follow through. This one, and we see a little bit of retracement. This one, and we see a retracement, right? Sometimes it could be a retracement, sometimes it will be a reversal. Here, price just missed the Keltner, so it doesn't qualify, but just for argument's sake, you see that the first one in the Keltner is the one that leads to reversal. Let's see if we can find more examples. Let me zoom into lower time frame here, like an hourly chart, and go to recent moment. And you see all these candlestick patterns basically indicating reversals, but not the ones we're looking for, because the candle reversal is not in the Keltner. All right, so these are all disqualified. So that's how you can be careful with taking reversal trades. This one, for instance, is the one that qualifies. Okay, let's take a look at that. We have a breakout to the downside. All right, so we're looking for a bullish reversal. These do not qualify because the candlestick reversal pattern occurs below the Keltner bands. This one too, but this one happens in the Keltner. So we have step one, breakout to the downside. Step two, we have a candlestick. No, step two is price is going back into the Keltner, and step three is we have the candlestick pattern, right? So this candle qualifies as a reversal, as a bounce, and basically that could be the entry. The stop loss always goes below the bottom, and the target could be the opposite side of the Keltner. It could be a fib, it could be a R2R ratio. The target is something that I'm flexible with. One could aim for the minus 100,000, minus 100 target, or the minus 200, or split it. You know, the target is always flexible, most of the time flexible with me. But this would be the entry candle, and this would be the stop loss here. Sometimes if higher enough time frame is used, even the candle low could be used. On our time frame, it could be okay. 4-hour chart typically is okay. 50-minute chart, I would not use a candle low, but always the bottom. All right. So in this case, entry is here. Stop loss could be here or here. okay, depending on the structure of the market, and that is a discretionary call. So this one, indeed, eventually, after a move up, consolidation continues with a breakout. That's a good reversal example. Let's see if we can find one more. This one is an example. It is a huge candle, so the candle itself is 90 pips, but it is an example. Price was above the Keltner. We have price back in the Keltner, and we have a candlestick pattern, and it did pretty well. As you can see, price nicely continuing. When looking for breakouts, I would not qualify this as a breakout, so I don't think that this one qualifies. Okay, we're looking for sustainable price above Keltner, not for a small kind of poke through it. So this does not qualify. This does not qualify. This does not qualify. Not to say that those potential reversals would not be interesting. I mean, you can see that price did make a retracement after that, but it's not for the particular system idea that that I have in mind with this, you know, this trading system. Basically, here we have momentum to the upside, but price does not show a candlestick pattern here. Here we have a bit of a push, but the candlestick pattern occurs when price is still riding above the band. So these are not setups because we don't have a candlestick pattern in the Keltner. Here you see substantial part of the candle above it. And here this one does not qualify because we don't have price above Keltner anymore. All right. So in all of this piece, we don't have a setup like that. So yeah, sometimes you have to basically be patient. Of course, you can scan multiple charts for that. All right, maybe here we have an example. Let's see. Here we do. Here we have an example. And you see that price, not really actually, this is not sustainable breakout. So that does not qualify. This one is not one that qualifies for this system, but obviously you can see sometimes that this could be a discretionary one for you, right? If you like good pin bar, good candlestick pattern, but it's not within the system that I'm discussing now. Let's see if we can find one more. Here, this one. Here price was riding above at the Keltner for a while. We see that price basically goes back into the Keltner and we see a candlestick pattern right there. So that's one that qualifies for this reversal. Let's see if we can find one more. But I think you get the point. Even here we see price breaking through it, and we saw it already here too. Excuse me. So the first candlestick pattern within the system, within the Keltner bands is here, and we see a retracement as well towards the band. So that's another example. So those are types of reversals that are high probability within kind of reversal territory. Reversals are typically riskier, of course. So this kind of filters out a lot of fake reversals, a lot of bad reversals. They therefore do not occur as often, but you can scan multiple time frames. You can scan multiple currencies, pairs, of course, to try to find more setups like that. But the advantage is that they do become a bit more more probable because of the fact that they're so scarce, right? Well, maybe not scarce, but they occur less than, as you can see, than maybe other systems, right? Other reversal systems. Now, that is one way of tackling Keltner bands. As I said, you can also trade the breakouts. That's a different approach. That's just looking at these types of candles and saying, okay, we are looking at price piercing through the Keltner. Typically when that happens, you get a continuation. So for instance, what I often do is look for the time frame on the hourly chart, for instance, look for a pierce through the Keltner like this, but then zoom in one time frame to look for continuation. So On an hourly chart, I see a good candle breakout, for instance. On a 50-minute chart, I'll be looking for the first consolidation pattern and then a continuation breakout. So here you see the momentum riding. I'll be looking for a triangle, a bear flag, something like this, and looking for the continuation. So right here you see the break after the break. So you see here that was the hourly break. This was the 50-minute break. That would be the entry right here. And stop loss typically above the Keltner would be good. Not above this top because it's a 1-hour chart, a 50-minute chart, so it's a bit better to have a bit spacious stop loss there and look for the continuation on a higher time frame. As you can see, nicely continuing. We got one question, one observation. Check the dollar yen. We'll take a look at that. Yes, they are for free. Keltner is, however, limited to 1 month. Once you download it for free, you have access with your demo for 1 month. Then you need a real account to keep using Algo Marker Keltner indicator. This candlestick pattern indicator is something that I have myself. It's not part of the MetaTrader 4 Supreme Edition, and I can send that to you. Just send me an email. To this email. So this is a combination of candlestick patterns with Keltner, looking for reversals or even breakouts. But if I look for breakouts, I typically like to look at one lower time frame and look for continuation breakouts. Not that not that taking the entry right there would not necessarily be good. If you take the 1-hour breakout here, for instance, put the stop loss below the candle low, you still get some pips there. But here, for instance, you see it wouldn't go too far before you run into some struggle there. So you got to be aware of this. Take care of trade management when you look for breakouts like that. I mean, you're going to run into some struggle here sometimes if the market structure is not that trendy, right? So you see already some failed breakouts. Well, not failed, but breakouts that didn't go too far. Here you see a good breakout. What I like about looking at one time frame lower is that you get more context and more confirmation that price is really going to continue with its breakout. All right. Here another good example of a breakout like that, but they don't always continue so nicely. So one way of guarding yourself against false breakouts is looking at good breakout candles and looking then at lower time frames for continuations. So these are a couple of good ones. We also saw a couple of bad ones. This one didn't go too far, as you can see right here. That was a bad one. This one is a good one. But typically, the Keltner band giving a very good indication of key levels, key zones, and if price action is strong when it arrives at that space, at that zone, you often get an acceleration. And if it's weak, you typically will see a bounce. Once you get the acceleration, right, then typically eventually you'll get a retracement, eventually you'll get a reversal because price will not continue above or below the Keltner forever. And you can use the candlestick patterns for those reversals, but keep in mind that the reversal candlestick patterns that are above the Keltner and below it are typically false signals, and you want to wait for the candlestick patterns that occur a bit later. As you can see in this example, you had a ton of those that were false signals and would have been all bad reversals. So anyone who is looking at the charts without Keltner might be taking a couple of these reversals and would get really bitten hard and run into some trouble here because of the fact that these reversal candlestick patterns didn't go anywhere. All right, with Keltner on our side, we're much quicker able to see which reversals have a chance and which are running into struggle. Okay, so that's the first thing I wanted to share with you. The second one, oh wait, let's take a look at dollar yen. 4-hour chart. These candlestick patterns, by the way, they are typically available for all time frames. Of course, the lower time frame, the more confidence is needed, in my view at least. You could easily take a look at the 4-hour, 1-hour, I think, with the Keltner. With the 15-minute chart, I would add something to it. I would add some confluence to it. I would add some analysis or indicator to it because, I think it's not the same kind of responsiveness. If you look at, for instance, let's take a look if we can find an example. Basically you're gonna get more. Typically, you'll see more false signals with this concept in mind. So you want to do extra filtering before you take a reversal on the 15-minute or 30-minute chart with reversals. Okay, with breakouts, I will be looking for patterns, for continuation breakout patterns, and candlestick patterns are useful too. So for instance, on the hourly chart, when looking at the dollar yen, we had a breakout here recently. This was the most recent breakout, and here. So on a 50-minute chart, I'm looking for a continuation. So we have a breakout. So we could look for a bullish candle, for instance, after the breakout, which is actually this one, right? That could be the entry. The first bullish candlestick pattern after the second breakout here is actually this one. The first breakout after a chart pattern did not really occur, actually. So let's keep it to this one and this one. These two on a 50-minute chart. So those would be breakouts. So you can use reversals and breakouts on various time frames, but just keep in mind that below the hourly, definitely for reversals, more confluence I think is definitely justified. On hourly, I think the Keltner should be fine. 4-hour is, of course, again, a bit stronger time frame for candlestick patterns than the hourly. But with the Keltner in mind, it should be okay as a combination. Regarding the dollar yen 4-hour chart, as Mario was asking, we can take a look at that right now. We can see, for instance, here that the price was riding above the Keltner indeed. So we're looking for a candlestick pattern within the Keltner, and it should create a reversal. All right, so that's something that's indeed pending. If there's a candlestick pattern here, this should qualify as a reversal on the dollar yen. And of course, be aware that they're not always going to work perfectly. This one is a failed one, and so is this one. All right. Now this one does not qualify. Why? Because we didn't have price riding above the Keltner. Okay, so you want to be aware of that. Here we had 2 candles, so I would not confirm that either. I think you need typically 3 or 4 candles, I would say is okay. The more the better, obviously. So this one right here, this candlestick pattern was a false signal, would have ended up in a loss, but there were a lot of candles going sideways. So from a trade management point of view, you could reduce the risk by moving stop loss to above these highs, for instance. Try to realize that if the reversal does not happen within 5 to 6 candles, typically it's taking too long. All right, so especially if you get price moving sideways like this within an uptrend, it's actually creating space and time for continuation breakout like that. So this is how you can be aware that reversals are not developing as you expect and are not really kind of setting up as you would like. In that case, they might be actually setting up for trend continuation, and that's the time to cut the trade short and take profit, or maybe even take a small loss and reduce the risk or move the stop loss, etc. All right. It wouldn't hurt to look at higher time frames as well and get an idea if a reversal is likely? Is price in a good reversal zone? Is there a support or resistance available? If that's true, then the probability of reversal occurring also increases. If there's divergence, the probability of a reversal increasing also goes up, right? So all these factors do play a role. And if you're able to analyze that, the better for you, the more probable you will be in catching a reversal that does work out. Reversals are always tricky, and these are all things that make the odds stack in your favor, okay? Here you see another example to the upside on the 4-hour chart. We had price below the Keltner. You see price moving back into it. The first candle right here, and we see a nice reversal take place, right? That one worked out fine. All right. Pound yen, we can take a look at pound yen. We got a lot of candles above Keltner indeed. One more note, you want to keep an eye on the candle of the candlestick pattern. I mean, a candle like this, for instance, is very small. It's a very small doji. So something to consider too. If it's too small of a candle, it's always good to have some kind of candle that has a bit of an impact and imprint rather than a doji of 30 pips or so with hardly any, any size. Okay, something to keep in mind. But indeed, if there's I would still consider, I mean, it's kind of losing speed here. That's the problem. So with the pound yen specifically here, it's not riding above the Keltner anymore. So I would therefore probably disqualify this one. It was doing well here, but the angle is it's kind of losing its angle. So it's not really qualifying. Now, there could be plenty of reasons still to take a reversal if you do your analysis, and you might still consider it's worth it, right? But that's a separate kind of calculation, a separate kind of analysis that's not connected to this idea, right? The idea here is really to trade the reversal after overextension. Now, it might be overextended, but it's below the Keltner, so it doesn't qualify from this perspective. Keltner is similar to a Bollinger Band indeed, Andy, but there is some difference in the way it moves. Bollinger Band has the tendency to balloon like this all of a sudden and then narrow down again and then balloon like this. As price volatility, as the price makes more volatility, you get these big balloons. Keltner does that less. It does shrink and increase in size, but not as drastic as Bollinger Band, which therefore I noticed for me, I like it more because I can see breakouts better because price actually breaks more often through Keltner from my observations, which makes it easier for me to detect when a sustainable breakout is occurring. And therefore, I like it more than Bollinger Band. Like here, for instance, you see price breaking through the Keltner. If we add Bollinger, it's also breaking through. Okay. Well, anyhow, so they are pretty similar, but that was my idea. You see here, you see, for instance, the price is riding above the Keltner, whereas Bollinger, it's already below it. So there are some differences that I noticed, and I just like it a bit more. Yeah, they're erratic is a good word. Thanks, Andy. They're more erratic, and this seems smoother indeed, more visually easier to kind of deal with or use the information or analyze the information. Keltner bands, I'm not sure. Send me an email. Maybe I'll ask Nenet. Maybe he has info on that. I'm not sure. I only know I've been using only Keltner with Admiral Markets, so Otherwise, I don't know, but I guess there should be somewhere another version of that. But you can always try it for free with Add-on Market demo account. Okay, that's one way of testing it, at least for a month. So that's one. Let's move on to the next one, which I wanted to share with you before I lose your attention here. So this is a cool moving average, and it's HMA. And what I like about it is the fact that it captures momentum so neatly. And it's a great way of understanding whether momentum is still continuing or if price is retracing. It's kind of like forward indicative with that in a way, because as price stays below it, we're definitely in momentum, in bearish momentum. And then if it then price candles or the candlesticks go above it, then we know that the momentum is really kind of making a retracement at that point. So just take a few minutes here or a few seconds to look at how price interacts with this moving average here. And I think you'll quickly see the advantage of it. Moving averages are great. I'm a big fan of them, but they don't have this kind of information regarding whether price is making a retracement or not. As you can see, it's a very early indication of a breakout or retracement. So as long as price stays below it, momentum. But as soon as price breaks above it, already here, it's already informing us that a retracement is a serious option, and it does make a retracement indeed. And that's one of the earliest ways, I think, to already catch that potential for a retracement. And here you see already price breaking below it and the HMA already turning, indicating actually the potential for a breakout, right? So now that happens here too, and we didn't. So I'll talk about that in just a second. It's not always that clear as this spot and this spot, right? Number 1 and 2. Spot 3, we get a bigger correction, so it's not perfect in that regard. But that's something that we can filter out with Fibonacci sequence levels, which I'm going to discuss in just a second. But it does give a fair, it's a pretty accurate tool on its own, just like that. As we can see, 2 out of 3. Plus, it's also an early indicator of momentum ending. As we can see here, we see a retracement. We see here a retracement, and here, and here. These angles do not repaint. This is all printed, and it stays the same. And the idea of what I like with HMA is basically combining it with the oscillator and combining it with Fibonacci sequence levels. So what I'm looking for is breakout continuations with the trend. So first of all, HMA below the long-term moving average. Long-term moving average is 144 EMA. All right, that's one thing. So we need to have a trend. So this is a downtrend. I would like to see the oscillators confirming that as well. So we have a downtrend here, especially the awesome oscillator should be down. All right. So what I'm looking for is breakout continuations. So basically this candle right here is the entry candle. We see the oscillator. We see price below the moving averages. That's a breakout. That's the first two things, the trend and then the breakout. So the trend is indicated by the alignment of the moving average and the awesome oscillator, and the breakout is indicated by price going back below the HMA. Okay, so those are the first two things. The third thing is the Fibonacci sequence levels. So what I'm looking for is a break below the third level or the fourth level, down to the fourth or down to the fifth. With big moving currency pairs like the pound yen, even a break below the fifth to the sixth. So that's when price makes the biggest trend. What the Fibonacci sequence levels do is plot the levels automatically. It's a script that I built for myself. This is the base level, 0. This is the first level from the base level. This is the second level. This is the third level. This is the fourth. This is the fifth. The difference between 0 and 1 is actually 13 pips. It's a Fib sequence level. On the hourly chart, the difference is actually 55. Why? Because on a lower time frame, of course, smaller pip movements have bigger impact. On a higher time frame, we're looking at bigger pip movements before they are relevant. On an hourly chart, the second one is 21. On a 50-minute chart, excuse me, hourly chart, it's 89. This is 50-minute. This is a 1 hour chart. On a 50-minute chart, we're looking at 34 and 144. So we're basically using the Fibonacci sequence levels to calculate the difference between these levels. The magical number is the third one. A break below 34, a break below 144 on the 1 hour and 34 on the 50-minute chart is where typically price starts to accelerate. I've placed the Fibonacci script at the top or bottom that is closest to the 144 EMA. So I don't put the script here or here on the bottoms that are not, on the tops that are not touching the 144. Only the top that's basically closest to the 144 EMA, which is here. So as price breaks below the first three levels and makes a retracement, I know that it already broke through the third level, which means that there's space down to the fourth and potentially fifth. So an entry here would indicate that there's a breakout continuation likely down to these levels, and entry here as well down to the fifth level. One of the reasons why I would not take this setup here is because price has reached the fifth level, and typically you'll see a bigger consolidation, especially on the Aussie, which is a slower mover, a slow moving currency pair. You would expect a bigger correction. This is how you can filter out, especially this setup, with regard to the continuation. All right? Now, this setup and this setup, you want to filter out too, just because of the oscillator. The oscillator is not trending down anymore, but up. Price is still below the moving average, but the oscillator isn't anymore. Excuse me. So that would filter out these two setups. So you filter out these three setups that are all, most of them failures, except this one. So actually 4 setups. This one, 2, 3, 4. The fourth one would have succeeded, but the first 3 not. No, actually, the first 2 not. The third and fourth would, but that's a different matter. Okay, so what does qualify, though, is this one right here. We have the oscillator moving our way. We have price trending downwards, and we've had a significant correction at the fifth level. Price retracing back, to the fourth level, and we see that the continuation downwards to the sixth level is possible. All right, so it didn't reach the sixth level, but we did catch a move of about 30 pips, which for a 50-minute chart is not bad. So especially between level 5 and 6, we have to be aware that price might move slow, might not reach the sixth target, especially when looking at the Aussie. All right, so this is how you can use basically the moving averages, the awesome oscillator, and the Fibonacci sequence tool script to these 3 things to make breakouts more successful on the lower time frame with the trend. Does anyone have a particular currency pair in mind that they would like to look at? We can do that right now. As soon as price gets back to the long-term moving average, basically the breakout continuation is reset. So as soon as price touches the long-term moving average, I can move the script to that top, okay? And I can start counting again, the third 1, 2, 3 levels. Yeah, the webinar is recorded indeed, and will be added to YouTube channel indeed. Yes. CAD yen. All right. Bit of an exotic one, so let's see how it works there. Alrighty, so what we're looking for is a bottom at the long-term moving average. So for instance, here we see a bottom at the long-term moving average, okay? Now, we would be looking for an upside. Let's say that price is, we're looking at price here, and you see that the moving averages are above in a bullish territory here, and the awesome oscillator is above the zero line as well. So this is the point where we would put the tool here, okay? Because at this point we have an uptrend. So that's when we would do it. We would not put the uptrend yet here, obviously, because it's still in a downtrend, okay? But let's take a look at the uptrend example first. Right, we place the tool there. Alrighty. So what we're looking for is basically the third level to break, which happens here. Okay. Then we see the retracement indicated by the change of the HMA color. And we're looking for the first candle break above it, which is this one. And we're looking for price to get to the fourth level and perhaps to the fifth. So the entry would be upon the candle close here. The stop loss will go below the bottom, and we would target the fourth level. Okay, so you see that there's about 19 pips to be made, and we get there pretty fast within 3 candles, and the stop loss is about 20, 21. So it's just slightly less than 1-to-1, but that's okay-ish. I mean, if you're able to get a few pips, the price a few pips lower, of course, that helps with the R2R already drastically. That would be sweet. You don't want to take it too much above it, because then the R2R is really shifting dramatically below the 1-to-1, which is not good. Unless you think there's a reason to aim for the fifth level. Okay. In this case, we didn't get to the fifth level. It broke down. It kind of missed it by a bit. That can happen. Realize that these are levels that are probable, but yeah, not invincible. It's not like there's a 100% ironclad guarantee that the fifth level will get hit, of course, right? Once we get to fourth, there's a good chance it gets to fifth, especially if it breaks above it. But as you can see, the markets are not always that accurate. Got to keep that in mind with your trade management as well, all right? So, yeah, that's a breakout right here. The point is that basically we had an uptrend, price above the moving averages, the oscillator is showing uptrend. We had a break above the third level, we had a retracement, and then a continuation. Hope that makes sense. That's on the CAD-Yen 15-minute chart. The next one would be, the next example would actually be, let's take a look at that, because price missed the long-term moving average here, so we don't have to recount. The difference between price, if price would have hit the long-term moving average here, the next setup would be invalidated, if you see what I mean. Because the fifth level would not be open anymore. We would have to redraw the fib tool to the next bottom. And we would have to first break above the third level before looking for breakouts. Is that clear? Just want to make sure that. Now, just want to make sure about that. In this case, it missed it by a few pips. So that fifth target is still open because of that. Is that clear? So basically, the fifth target is open and alive as soon as price breaks, I would say above it. I mean, it's even possible to take a breakout setup here, this one, okay, because of the fact that one might expect the uptrend to continue. We had a respect for the fourth level, but there could be an immediate follow-through without necessarily the breakout. When I look for a breakout of the third level, I really need to see a breakout. When looking from the fourth to fifth level, it could be a breakout or it could be a retracement like this. It really depends on my analysis and the overall market structure, how much I like the setup. But this one could be valid. Okay, so from that point of view, it didn't break out yet, but we are above the third level, which is important. And we bounce off the third level, as you can see. So this one is a breakout candle, and we get some follow through, as you can see, but not reaching the target. So trade management is important. Try to find the spots like bottoms that make sense to reduce the risk. Here is a potential one as well. The breakout here is very small, so a bit iffy, I would say, on a 15-minute chart. We do have a candle above it, and we do get a small push. That's a bit iffy. The next one is a bit better because you get, again, a pullback to the third level without hitting the moving average. The next candle that closes above that HMA is this one right here. That's another entry, and you get another 30-pip push. All right? The next one is something that I think is not a good example. A big candle like this. No, actually, the moment the HMA turns, we're looking for the HMA to turn as a negative candle. So that's not a good setup here. So that's one where you want to skip it. All right, so what now? If you're looking at the charts right now, nothing has to be done because basically price is not trending at this point. Why? Because we need price to, if anything, it's trending to the downside. So we could put the tool on this top, which is the closest top to the long-term moving average. All right, and we're looking for a breakout below the third level. So we need price basically to break below this, then make a retracement, and then make a new breakout like that. All right, and that would be a valid setup to the downside. Do you see that? I would just want to check if you see this visually already in your mind. You know, if you could already see that kind of pattern occur. So why do we have the sequence level here? That's the top, the closest top to this moving average. Why do we have it pointed to the downside? Because price is in a downtrend at this moment. We have oscillator bearish. We have price below the moving averages. Moving averages aligned to the downside. We're not looking for a setup yet because the third level is respected. We're looking for a break below the third level, a retracement, and then a continuation to the fourth and fifth. All right? Anyone else have a currency pair in mind? We can take a look at that right now. We can look at the most recent. Yes, we can look at an hourly example too. I mean, this is, you know, the webinar was more for intraday, so I was looking for advice on these types of time frames with regard to breakouts. 1 hour chart for reversals because, as I said, I think that reversal trading on a lower time frame just is a bit more tricky. It does take a bit more experience, and hourly chart is just a bit more sturdier. 4 hour chart, of course, again, a bit more sturdier. For breakout continuations, there's a bit less kind of demanding. We can use the same concept for hourly charts too, indeed. We can take a look at the example right now. But does anyone have a currency pair in mind? Euro pound. Okay, good. It's not my favorite pair, but that's fine. Extra challenge for me. Let's take a look. Let's look at the hour chart as promised. So we need to pick a moment in time so we can analyze it. I mean, now, if we look at it now, rather than looking at the historical examples, excuse me, basically we're looking for upside. Why? Because price is above the long term. The moving averages are aligned to the upside, right? And the oscillator is showing upside. So we need the bottom closest to the long-term moving average, which is this bottom, and we'll put the sequence levels there. So let's do that right now. All right. And we need to break above the third level. So as you can see, it's going to need a lot more movement before we get a breakout into breakout territory. See, it's only at the first level. So before we get a trending environment, a retracement, a continuation, it's going to need a lot more movement on the euro pound. And that's not so strange because, of course, the euro pound is a slow mover. So typically you don't get into those situations that quickly with the euro pound as maybe a pound yen. We can take a look at some historical examples. For instance, here you can see that there was probably nothing to look at because price was bouncing around that long-term moving average. But we could take a look at this downside here, perhaps. Let's take a look. All right. So we have a break of the third level. we have a downtrend, break of the third level, we have a retracement, and we have an entry somewhere here, which basically doesn't go anywhere. I would, with regard to the stop loss, use probably this top here with the euro pound. So we don't get stopped out on this retracement, and we survive that, but it does take a long time before the market goes our way, so it depends on our patience and trade management. The next one, the next entry here or here is a better timed one. However, do realize that the price has already hit the long-term moving average here, therefore actually kind of resetting that downside, okay? So therefore, basically, you'd have to count again from this level. So I don't think we'll see as many examples on the euro pound due to its slowness, where we have momentum, continuation, and breakouts. Let's see if I can find maybe even more back. Let's see, here perhaps, yeah. Because we're looking for a trending situation because price has to get above the third level. All right, good. So we have an uptrend, we have the bottom. So let's take a look at that. All right, so basically here we're above the third level, so we're looking for retracement and continuation. Technically, this candle would qualify, this candle would qualify, this candle would qualify, this one would qualify. Now, the closer you get to the target, obviously, then you want to be careful. Like this candle right here is so close to that fourth level that disqualifies it. That's something you want to keep an eye on. This candle right here is so close to that fourth level, you want to be careful too. Although we hit the target already, so this could actually be aiming for the next target. So it might be okay, this one, from that point of view. This one is better because it's already above the fifth level, the fourth level, excuse me. All right, so this one is disqualified, but here we see a couple of examples that nicely qualify. All right, and this is how we capture that continuation from the third to the fourth and from the fourth to the fifth level as a continuation to the upside. Maybe here another one. All right, so we're looking for, once again, we're in an uptrend, price is aligned, oscillator is aligned, okay? We're looking for break of third level, and then we're looking for retracement and continuation. So we're looking for a trending environment on the oscillator too, right? So this retracement, therefore, is quite deep. So it's therefore riskier to take this bounce. Why? Right here. Because of the fact that we could expect a bigger correction, which indeed happens. It's a better moment to look for when the price is set up with this as well, with an uptrend there. So for instance, price goes back and the oscillator here in uptrend. So here, right here, these candles are a better moment to take the trade where I have the green arrow than where I have the red arrow. Okay, because the oscillator is set up again. Right? Just because we have the moving averages set up it's not enough. The oscillator helps. So we have both the uptrend on the moving averages, we have the oscillator, we have the breakout above the third level, the retracement, and now the continuation to the fifth level. Okay, now we missed the fifth level by just a bit, as you can see, but it was awfully close. It was just like 14 pips. So you want to also take that into account with your target. Aiming for like the very last pip is not something I do. I typically, if I have a take profit, if I use a take profit, I do kind of go like a couple of pips below that, depending on the time frame, 5, 8 pips on a 15-minute chart sometimes. Well, no, that's quite a lot actually, 15-minute chart. No, that's more like, that depends on the R2R and what target I'm aiming for. If it's a tight R2R, I would be not giving giving up 5 pips, obviously. If it's a more spacious R2R, then yes. With the hourly chart, of course, you could easily go for, let's say if I'm entering here and I'm targeting the 185 pips, aiming for 160 is fine, obviously. So you don't want to squeeze every last pip out of a big target like that. So now, of course, there's a gap here. So taking setups in this piece is not ideal because of the weekend that's about to arrive. But let's say there would be no weekend, then theoretically, these would be entries too, right here and right here, with a stop loss below this bottom, aiming for this top, this fifth level. Okay. I mean, in practice, we shouldn't do that because of the weekend. So it'd be not a good thing to do. But if it were not for the weekend, right, that would be qualifying it. The weekend disqualifies it, but without the weekend, it would be okay because we're breaking above the fourth. We have the retracement again. This is still above the zero line. We still have the uptrend. And we still have that target open. It's a great way for understanding when the market is trending, when is it retracing, when is there a good chance of continuation. It's the oldest trick in the book in a way, is it's buying the dips, selling the rallies, but at a moment where we're not guessing that the retracement is over, but we have more information that the retracement is probably over and we're in the new or the old trend. We're back in the trend again. Classical trend trading in a way, right? And yeah, I'm a big fan of these concepts because they help filter out when it's trending, when we can expect the continuation, when we can expect the momentum as well. And we often get a pretty good spot within that trend. So I don't have time for that third part I wanted to show you with regard to time factor, custom fractals, and the animal market pivot point. Animal market pivot point is often I use weekly pivot points for bounces. I look for chart patterns basically. So, you're looking at a strong weekly S1, for instance. What I look for is then price to hit that. I'm looking for price to respond to it, react to it. I'm looking for a time factor pattern on a lower time frame, kind of like a weakness. I'm looking for a reversal away from that pivot point. That's the third thing I wanted to show you, but unfortunately not time today, but no time today, but we could discuss it in a live webinar later this month, no problem. And he uses animal pivot points and he loves them. I totally agree with that. Very useful. I use weekly, but daily is perfectly fine for intraday trading as well. They're great levels for support or resistance, understanding where where price could bounce or break. And but I don't trade right at them. I wait for time factor patterns, time patterns on lower time frames to get more information about the reversal. Or continuation, break, pullback, and continuation. All right, so I use those. Basically, I use the pivot points as a bounce or break spot, and then I use the time factor for understanding which one's happening and the entry as well. All right, so we can discuss that another time. With regard to the second version, the second system, sorry, that I was discussing, it's it's key to, it's a key concept to basically catch the trend, know how much the market still has left, what is the likely target, is it trending, and is it back in the trend using the moving average. So key concepts here, the HMA, the oscillator, and the Fibonacci script. If you want one of these concepts, one of these indicators, you can write me to this email. Let's take a look. I had it somewhere here. Okay, doesn't matter. I can't find that email, but I would just write it again. Of course, also if you want the candlestick indicator, you can do that as well. Just let me know. If you want the pivot points or the Keltner Admiral Market pivot points, you can get that through MT4 Supreme Edition. If you're interested in the HMA, the special moving average here, which is different than the HMA, if you want the Fibonacci script, excuse me, those are mine, and you can ask that as well through the same email. All right, so you can either download it from the MT4 Supreme Edition for Admiral Pivot or Keltner, or send me an email for the ones I just mentioned, the script and the moving averages. We can take maybe a look at one last example because I'm such a big fan of this trend trading that I just want to show you one more. Does anyone have a currency pair in mind? We'll take a look at the 1 hour chart. All right, dollar CAD was first. All right, so we're looking for a trend. So basically, here we already had an uptrend from this moment onwards. So we would be putting the sequence levels from this bottom. By the way, this is a script. I saw a question about that. So I can send that script, DJan, to you. And it automatically plots this level. You just have to basically drag the script to the bottom or top of your choice, and it just plots those levels automatically. And we're looking for a break. So we have an uptrend, right? Check. We're looking for break of the third level, which happens here. Good. So we're looking for a continuation, which happens here, right? So that's the entry. The stop loss has to go below a bottom that is not too close. Like this is, for instance, if we go below this bottom, it's not even a bottom yet here. So don't use this level. You got to use at least the closest bottom actually on this chart is here. All right, so that's a bit far. In this case, it's about 112 pips. So in hourly chart, that's a lot. So we would probably skip that because of the size. It would probably make more sense to wait for this setup and take this as a bottom. All right, use this as a stop loss. And price then continues, misses the fourth level, unfortunately. So either we would have to trade management that because price dips below the moving average again here. You see that? So take a look at that. If we take the entry here on this candle as it turns the second time, use this as the bottom, right? Put stop loss below this bottom. We're looking at about a 28 pip stop loss, about a 31, excuse me, and price moves up about 46 pips. Okay, it misses the target by about 20 pips. So it depends how tight we have that target. If we have it exactly at this level, we would miss the target. But we'd see price break below this moving average once price has been close to the target. That is typically a warning sign that you want to exit, or you want to at least move to break even, or you want to reduce the risk. So it would be a trade that would probably not lose if done properly. Okay. The next setup would be actually not here because it has hit the moving average again. So we'd withdraw the moving average again. Sorry, we draw the sequence levels from this bottom again, looking for the break above the third level, which happens here, and looking for a continuation, which happens here. Okay, so that would be the entry right there. We're looking for a stop loss, a bottom that is here. Basically, this is the bottom. The bottom that hasn't been broken is here, so I have to draw a line right there. All right, and we're looking for a move up to the fourth level, right, which happens here, and we got the target hit. Now we could keep aiming for the fifth level, and that would still be open, and price is very close to that. All right, as soon as price hits the fourth level and makes a retracement, a new entry could be done potentially here. A new entry could be done as soon as price breaks above the fourth level, somewhere in this zone here or here. Those are all potential entries as price has broken above the fourth level, and now we're looking for that continuation. It took a while, it kind of went sideways, and now it's pushing higher indeed. Once we get closer to the fourth level or fifth level, of course, then the entry is less interesting because the R2R is not good. Here, probably not so good because we're too close to this fifth level already. Unless the stop loss is very tight, if we were to use this bottom and we have an entry somewhere around here, you know, the risk could be small compared to the reward, might still be okay. But, you know, obviously the closer you get to the target, the higher the chance that that setup is not interesting anymore. One more, because I'm enjoying this. I hope you too. So last example, then we'll really close it for today, is the odd yen. So we are looking for the hourly chart, and we're looking for a trend. So here we had the uptrend. Here we have a downtrend at this moment, by the way. So let's first talk about the uptrend. Right here, we put it here. We didn't break above the third level. You see that? So it didn't qualify. Here at this moment, we're only at the first level. So we have nothing to do at this moment. We're waiting for breakouts, basically. Okay. Here, I don't know if this was testing the third level. I don't try to break out. The question is if it really succeeded. Probably we would have ignored this one, right? So let's skip that one. Here's probably a good example. Downtrend. All right, price broke below the third level, as you can see, hit the fourth level, excuse me. So here's the setup, but the stop loss would have to be all the way above this top, which would survive because here's a top, or even here, maybe, would be quite a large stop loss. Or here, which is a lot better, right there, this one, this candle, didn't hit the long-term moving average, so it's still okay. That would be ideal setup for the fourth level, and then later on to the fifth, as you can see. Another setup would be here, and here, and here, and here, and even here, down to the fifth. With this one, it might be tempting to put a tight stop loss just above here. If you do that, that would be a loss. If you go with this more spacious stop loss above here, it would probably survive. Then we hit the fifth level, which means that we're more cautious. We don't want to take anything in here because it's at the fifth level, obviously. We might consider this one because we've had the bigger retracement already occur, so we might be heading towards the sixth level in this case. But always realize that if you hit the fifth level, especially on a slower mover like odd yen, that price might not get to the sixth level. All right, and then price hits the long-term moving average here, which disqualifies the entire process, and we have to wait for a new trend again. And we have to draw the Fib tool again on the charts, and we're waiting for a break of the third level. Realize one thing though, on a pound yen, big movers like pound yen, pound odd, pound New Zealand, euro yen, it is better to wait for the break of the fourth level because those move so quickly that they break the third level very rapidly, and it's not yet a trend actually. So there it's better to wait for the fourth level, break, and trade it to the fifth level. Wait for the fifth level, break, and trade it to the sixth level. So it shifts one level up. Instead of from 3 to 4 and 4 to 5, it's better to wait for 4 to 5 and 5 to 6. All right. Any questions on any of these two systems? We're way over time, so I'll be wrapping up, but still just a few minutes if you have any questions on what we discussed today. With regard to new webinars, you can check that out, of course, right here. Education, Forex and CFD webinars. Go to admiralmarkets.com and you can sign up for the upcoming webinars. We've got a lot of things going on coming up. We got Pro Learning Lab webinar on French presidential election next week, Monday. Thursday, we take a look at the trading instinct, how you can basically get a gut feeling about trading, about your trading decisions in a positive way rather than in a fearful way. A lot of things going on. Candlestick chart training, live webinars, May and June. So hope to see you in one of those. Analytics, of course, articles. You can find it at admiralmarkets.com. Plus the MetaTrader 4 Supreme Edition if you're interested in Keltner once again, or the pivot points, which we didn't have time to discuss, but you can find here the demo version of that MT4 Supreme Edition. And yes, you can email me for those scripts. Let me show you the email address right here. I can send you the script for the Fibonacci. I can send you the moving averages, the normal moving average, colored moving average here, and the HMA. And for the Keltner and the pivot point, you can download MT4 Supreme Edition. All right. Well, no questions so far, so no problem. If there are any questions, you can always use the live trading room webinars to discuss this and share your experience with me, how it went, what questions you might have, etc., etc. Great, Andy. Good. Happy to hear that. Looking forward to your email, and try it out. I think you'll see how the third level sequence levels are really great for catching trends. In any case, hope to see you soon, and wish you all great trading, folks. Cheers.